CFA Level 1 Quantitative Methods, Learning Module 1, Rates and Returns. Grab your BAI Plus calculators, guys, because we're skipping all the fluff today and jumping straight into the concepts most heavily tested on exam day. Let's get right to it.
Section 1. Interest rates and their components, specifically the three interpretations. Okay, let's dive into this. So the very first trap to avoid is misunderstanding the absolute foundation of finance, the interest rate. It's not just money you get from a bank, right? We actually interpret it in three distinct ways. First up, it's a required rate of return. That's literally the absolute minimum return an investor demands before they'll even think about committing their money. Second, if we're looking backward, it's a discount rate. If you know you're getting a cash payout in the future, you use this exact same rate to discount that money back to figure out exactly what it's worth in today's dollars. And third, it's an opportunity cost. Tying up capital in one place means giving up the chance to invest it somewhere else. The interest rate is basically your compensation for that lost opportunity. Mathematically, all three of these describe the exact same thing.
Now, investors don't just get paid for waiting around, right? They need to be compensated for risk. And honestly, the most dangerous, silent risk of all is inflation. This brings us to the nominal risk-free rate. This rate takes the real risk-free rate, which is what you demand if inflation literally didn't exist, and adds an expected inflation premium to it. Why? Because you absolutely must be covered for the expected loss of purchasing power while your money is tied up. So when a bank advertises, say, a 3% return, that is a nominal rate. It hasn't factored in how much purchasing power you're actually gaining or losing in the real world. And that brings us to a huge exam focus. You absolutely have to memorize this relationship. The nominal risk-free rate equals the real risk-free rate plus the expected inflation premium. The CFA Institute loves testing this because they know that under stress, candidates just blank on the basics. Lock this formula in your brain right now. It is a guaranteed easy point on exam day.
But we're not done there. Beyond just inflation, investors demand extra compensation, or premiums, for taking on specific risks. There are three big ones you need to know. First is the default risk premium. This covers the very real possibility that the borrower just fails to pay you back. Second is the liquidity premium. Think about it. If you need to sell fast and you have to take a steep discount because there aren't many buyers around, you're going to want compensation for that upfront. Finally, we've got the maturity premium. Basically, the longer you lend your money out, the more exposure you have to fluctuating interest rates. A 30-year bond carries way more interest rate risk than a 3-month bond, for sure. So let's see how this builds your conceptual understanding for test day. The exam is frequently going to give you two different securities and ask which premium explains the difference in their yields. If they ask you to compare treasury bonds to corporate bonds, they're testing your grasp of default or liquidity risk. Governments print money, corporations don't. But if they compare short-term bonds to long-term bonds, they want you to spot that maturity premium. If you understand the why behind these differences, you'll dodge their traps easily.
Moving on to Section 2, Central Tendencies, and specifically the three types of means. Calculating averages is totally foundational to measuring how well an investment has performed. But in finance, not all averages are created equal. We've got three primary ways to calculate them: the arithmetic mean, the geometric mean, and the harmonic mean. Let's get the mental framework set up right now for exactly when and why you'd use each of these tools. The absolutely most crucial distinction you're going to make here is between the arithmetic and geometric means. The arithmetic mean is simply adding up the returns and dividing by the number of periods, just like you learned in grade school. You use this when estimating a future one-period return. But the geometric mean measures the compounded rate of growth over multiple periods. Whenever you hear the phrases compound interest or annualized return, you need to instantly think geometric. Think about it this way. Let's say an investment loses 50% one year and then gains 50% the next. Your arithmetic average, it's 0, but your actual geometric return is deeply negative because your overall capital base shrank. So for historical, multi-period performance, always use geometric. Now, what about the harmonic mean? Listen up, because this is a massive exam focus. I want you to mentally wire a trigger warning in your brain for this one right now. If a question mentions that an investor is putting the exact same dollar amount into an investment periodically, like, say, buying $1,000 of stock at the beginning of every month at different prices, instantly think of the harmonic mean. The exam is way more likely to test if you know when to use it, rather than making you crunch a massive manual calculation.
Okay, so the crucial takeaway here is knowing how these three relate to each other mathematically. Here's a clean, simple rule. The arithmetic mean is always greater than or equal to the geometric mean, which is always greater than or equal to the harmonic mean. Just remember A before G before H, right? Like the alphabet. Why does this matter? Well, this one rule will literally save you 3 minutes of blind calculating on a multiple choice question because you can use it to instantly eliminate wrong answers without even touching a calculator.
All right, Section 3, portfolio returns, time-weighted versus money-weighted. Now, what's really interesting about this next topic is how we evaluate who's actually responsible for an investment's performance. This is an incredibly high-yield area for the exam. Here's the distinction. The time-weighted return measures the portfolio manager's skill. It completely strips out the impact of when cash is deposited or withdrawn. And that's exactly why fund companies always report time-weighted returns. They can't control when an investor decides to buy or sell the fund, so they really shouldn't be penalized or rewarded for it. The money-weighted return, on the flip side, measures the actual investor's experience because it absolutely does factor in the timing and the size of those cash flows.
While understanding all that theory is fantastic, remember you are going to be super time poor on the exam. You must know how to perform the money-weighted calculation using the internal rate of return, or IRR function, on your BAI2 Plus calculator. Honestly, trying to solve a money-weighted return manually is just going to eat up your clock. Muscle memory will save you here. Just practice that IRR function until it's second nature. The CFA Institute loves to test your intuition on this with situational traps. Just imagine a scenario where a fund is having a really great year, so an investor gets super excited and dumps a massive deposit into the fund right before a terrible year. Because a huge amount of capital was exposed to that loss, the investor's money-weighted return is going to be significantly lower than the manager's time-weighted return. Understanding this dynamic is going to prevent you from just blindly memorizing formulas. And that brings us to Section 4, magnification and calculating leveraged returns. Let's move into our final high-yield topic for this explainer, leverage. Simply put, this is borrowing money to increase the size of your investment. But listen, leverage is a double-edged sword. It's the ultimate magnifier. If your investment earns more than what it costs you to borrow the money, leverage dramatically boosts your returns. But if that investment earns less than your borrowing cost, it severely magnifies your losses. It just violently accelerates your outcomes in whichever direction the market happens to move. Let's walk through the math step by step so you can see exactly how this plays out. Imagine you invest $50,000 of your own equity and you borrow another $50,000 at a 4% interest rate. Boom, you now have a $100,000 portfolio. Now, let's say that portfolio earns a 10% return. 10% of $100,000 gives you a total profit of $10,000. But wait, you have to pay your borrowing cost. 4% on the $50,000 you borrowed is $2,000. Subtract that from your profit, and your net profit is $8,000. To find your return, you divide that $8,000 net profit by your initial $50,000 equity. The result? A 16% return. So a standard 10% market return got transformed into a 16% leveraged return just because you borrowed money cheaper than what the investment actually earned. And here is a critical exam warning regarding this exact formula. The leveraged return equals your total return minus borrowing cost, all divided by your equity. The single most common mistake candidates make under exam pressure is dividing the profit by the total investment size, like the $100,000 in our previous example. No, the denominator must strictly be the investor's own equity. Write that down, underline it, and please do not fall for that trap on exam day. So we've covered the three interpretations of interest rates: the risk premiums, the mathematical differences between the three types of means, and the dual mechanics of portfolio and leverage returns. You know the traps now, but honestly, knowing the theory and surviving the clock are two completely different beasts. So what does this all mean for you? Will you be the one who falls for the leverage trap, or the one who completely conquers the time value of money next? Grab your calculator, run the reps, and I'll see you in the next explainer.